everybody. This is Mortgage Pros 411. I'm Audrey Boycno with my co-host Kevin Casey, and today we are joined by the lovely and smart Victoria DeLuz. Good morning, Victoria. How are you?
Good morning or afternoon for me now, guys.
Oh, yeah. I know. I get called out on that occasionally. I should remember that we have people across the country, for God's sake. Sorry, guys. Good afternoon. All right. So a few little housekeeping things. First of all, what is the date today? It's December something or another.
Yeah.
We've been
December
talking
12th,
about
we're at.
NMLS since July, right? NMLS, remember NMLS? Yeah. So if you haven't renewed your NMLS, you need to do it now. And if you haven't taken your continuing ed, you really need to do it now. Go to MEC Mortgage Educators, use the discount code COUNTDOWN. And trust me, kids, it's a countdown right now. If you think you're going to get it all done by the end of the year and be legal on January 1st, you're cutting it close. So get on it. So there we
You
go.
really want it done by December 15th. That's like after that, you're in trouble.
Yeah, well, yeah. All right. So also there are Christmas parties or holiday parties. Sorry, kids. North Bay Camp has one tomorrow between 4 and I think 7. And then there is an Originator Connect one down south on Friday, which I was really hoping to get to, but I don't know if I'm getting down there. So anyway, go out and support people who have taken the time, energy, and money to throw you a holiday party. It is fun getting together with other people.
It's good to talk to your competitors and find out how they're getting through this craziness. And, you pick up tips and tricks that they will share with you. And that's how you learn how to get more loans done. It's just,
yeah.
And be happy I'm assuming going to be a warm holiday party, unlike my holiday parties in Detroit.
Oh my gosh, Detroit, what is the temperature in Detroit right now, for goodness sake?
Well, actually it's sunny outside right now, but typically we're hovering right around, mid to low 30s this time of year.
Oh wow. I was thinking I was cold and it was 60, so I guess I should stop it, huh?
That's what makes us Midwesterners so tough.
Yeah, exactly. I'm wearing wool and leggings and thinking it's freezing outside. So thank you for the reminder that we have much to be grateful for. Just a quick note. Well, okay, so let's just start with today. Okay, let's start with today and the CPI announcement, the Consumer Price Index, the inflation numbers that came out today. So we were expecting it to be up 1/10. It was. Year over year went from 3.2 to 3.1. That's headline. Core was up 0.3. It's unchanged with a headline core reading of 4% year over year. Remember, kids, we peaked. That headline peaked at 9%. And there are a lot of variables in here that are really interesting. But Victoria, you have some interesting insight into the inflation numbers, since we have PPI coming out tomorrow, the Producer Price Index. And this idea of, oh, everything's hunky-dory and it's all coming down. Share with us, and try not to make us need to up our medication or anything. Go.
This is what I'll say. Us as participants in the mortgage industry, we follow these numbers religiously. Or if you don't, you should.
Yeah,
Or you should. And I think that by us being so in tune with it, and we're looking for that next number and looking for that next number, sometimes we forget what that actually means for the broader economy. And so, yes, inflation is coming down on a month over month and a year over year basis. But when you actually look at it over the time period of the last 2 years or the last 3 years, consumers are still feeling those really, really intense effects of increased prices over the last 2 years. So while the CPI, the Consumer Price Index, which basically just measures how much are we spending out of pocket for things. So when you go to the grocery store, and that's actually a key difference between CPI and PCE, personal consumption expenditure, which is the Fed's preferred measure, because PCE actually measures how much things cost in total, where CPI measures how much are you as a consumer paying out of pocket to get that thing? And so like where that really kind of comes in is like, what was that?
That's the one I care the most about. What am I paying?
Yeah, that's what you should care most about. Yeah. And your borrowers and everybody else. But that's why,
the Fed doesn't agree, huh?
Right. The Fed's got different things in the back of their mind. But anywho, so over the last 2 years, it's not just like you said, we peaked out at 9%. And I don't recall exactly what month that was. I want to say that was what, September, October of last year?
I don't remember the month either.
Yeah. So
Yeah.
it was somewhere in there. So you take that 9% and you take that 3%, you add those together.
Okay.
That's so inflation over the last 2 years isn't
Oh, yeah, 12%.
3%, it's more like 12%. And so what you could buy something for in the beginning of 2022 now costs 10, 12, 15% more, depending on what it is that you're buying. And Audrey, one of the things that you brought up was used cars and what's going on in that. So you actually dug in and read the report. I was on a bunch of calls earlier, so I didn't get to dig into the report exactly, but like, tell us what you're kind of seeing in that respect.
Well, it's interesting because the used car indexes, including Manheim, which I have a note here somewhere actually saying exactly what it said, but they've been coming down for the last 5 or 6 months. And then Manheim used car report. So it was down 2.1% month over month, and it was down 5.8% year over year. And that was out of a report last week. And then today, when you get today's report, and it includes used car prices, and it's showing that they're up 1.6%. So it shows that index is incorrect. And it's lagging, right? But it's not even that it's lagging. It's that because if the used car prices have been coming down for 5 to 6 months and year over year, they're down that substantially, then my understanding is that BLS is going to revise the way that they look at some of their stats.
And they do this all the
in
time, by the
January.
way.
Pardon me?
And they do this all the time, by the way. And the reason why is because the way that, oh, I don't know what just happened there. That was weird.
I don't know. Nothing
My
happened.
my whole teams came up in front of me, and I'm like, oh, what happened? But anyways, to get back to that, the reason why they revise their calculations is because we don't stay stagnant as consumers.
Exactly.
The way that we participate in the market, like, think about this. Think about the jobs report, which I know that we're going to talk about. But the way that that's calculated. So remember, like, there's not like some big supercomputer that gets all of the data from everybody all at once. It's a survey. It's a survey that goes out to companies and individuals, but typically companies, that says, hey, are you hiring more people, or are you laying off people? Like, what's kind of going on? And that's why we see those revisions the following month, because they may not all have all of their participants participating. And their participants are a much smaller subset of the overall population. So it's kind of a guess. It's our best guess of what's actually going on. And that's why I get, and I'm not going conspiracy theory on you, but we have to remember that those are estimates. Those are surveys that are dependent on how the people are answering those surveys. And when you think about the overall employment environment, you have so many people out there that are living in this gig economy. Think about mortgage originators, right? How many mortgage originators do you know that have 1 or 2 or 3 other jobs? Rather it's, they're investing in real estate, or they're flipping houses, or they're, duly licensed as a realtor, or they're doing all of these different things. How is the BLS capturing that?
Well, so this is, and the people who listen every week know that I refer to the BLS number as the BS number, because I don't see the value in a report that is always wrong. I mean, almost always. And this revision thing, come on, if you can get the New York Stock Exchange to be correct down to the penny in the moment, why can't we get this right before we release it? So I've had this argument with economists, and they say, well, if you wait till they get the data correct, then it will be old data. And I argue, how can bad data be better than old data? And they are so.
And this is the argument that they should be giving, though, is that, look, we get it. It's not perfect, but it's the best we've got. And until somebody wants to start investing a bunch of money to create the New York Stock Exchange, nobody makes money, I mean, directly off of this information. Now, we all make money if we invest in the market, or, the way that the bond market moves for the mortgage industry, but there's no real market for that information being 100% correct.
Okay, but what is the value of having so skip it. Just skip it. Don't even do it, because it moves the markets. It's been moving the markets long before I even understood all this. It drove me nuts because
It's the trend.
Oh
This
my.
is the one thing that I talk to every, like, even mortgage companies. So let's talk about mortgage companies, okay? And most really, really well-run mortgage companies watch their metrics.
Mhm.
Like
Yes.
they live and die by them. They
Yes.
know how many underwriting touches there are. They know what their profitability is. They know all of these things. Now, that doesn't mean, even for mortgage companies, like doesn't mean
Right.
that they don't get revised financials or there wasn't a glitch in their system but you watch the trends. And that means that you have to watch it every day. You have to watch it every month. And you need to have conversations about it with other smart people. So if you do notice something that's off, like I did a podcast yesterday talking about servicing value with arguably the best servicing guru in the world. And most loan officers, when they, at least most loan officers that I talk to are like, oh yeah, servicing. We have a servicing department. We hold our own loans, but we skip over that part of valuing the servicing. And I know I'm kind of digressing and going off on a tangent here.
No, that's important.
That's what we do. That's all we do.
Perfect.
Yeah.
So
knock yourself out.
One of the biggest components of the premium of your interest rates is the servicing value.
Mhm.
So rather you are retaining servicing and you are putting a value on it, basically, what do you expect to make on this over time as the borrower continues to pay their payment? And if you have your own servicing department that's collecting those payments and distributing it out, obviously you're going to make more the longer it sticks around. And I mean, nobody likes to say this, but hey, and if your borrower, for you mortgage company misses a few payments here or there, but they never go like truly, truly delinquent, you get to make a couple late fees and like that kind of stuff. But so that's one aspect of it. Also, you have companies that sell their loans elsewhere and they get an SRP, servicing release premium, which means that they get the money up front.
Right.
And those are like, rather it's MSR, you're retaining it in-house, or SRP, you're selling it off somewhere else. That makes up typically about half of the premium for any, like if you're offering a 7% interest rate today, and you need to bring in 300 basis points to pay yourself, pay the company, pay your expenses at your branch, half of that premium is coming from servicing. And so to kind of tie us back into watching the trends, it's not to say that like, 1 week or 1 month, servicing is a little out of whack. It's all about watching it consistently and watching those trends to see how we're tracking. And that's why, like, even though the BLS, it's not accurate, we don't have anything better. I do play conspiracy theory with it sometimes. You made a joke earlier, Audrey, about how like PPI is coming up and you're like, oh, the Fed probably already has that number. I mean, you're probably not wrong. I know, who knows, right? Like, like we just found out that like aliens were real and, our federal government knew about it. Do we think like stuff like that doesn't happen? Now, I don't want to go too far down the rabbit hole, but back to my point of watching trends, that's the important part. And it does disappoint me to see the market have such knee-jerk reactions to that kind of stuff. Now, the other thing that I wanted to point out real quick is it's not just so much that the whole herd is going in one direction and having a knee-jerk reaction. We, especially in the mortgage-backed security market, we have fewer participants right now. And you notice the volatility more when you have fewer participants. Now, if we had a $4 trillion robust market, now granted, the mortgage-backed securities that are being traded every day are a heck of a lot more than what we're originating because there are different older vintages that are still being traded out. But my point is when you have fewer players, you feel those moves a lot more.
Right.
Versus when you have a lot of players, the volatility just doesn't feel like as much.
Same thing in real estate. When there's fewer buyers, the difference in the swing between the two different buyers is big. Versus
yep, you got it.
All the prices in about the same part.
Yep.
It's interesting too, because I've always, we know this, like if we're going to have a holiday week or weekend, we know that people are going to leave early. The traders are going to leave early and there's going to be less people. And so there's way more volatility if you're releasing some market moving report on a Friday. on a holiday weekend and it's going to make the jerks much harder either way. I'd not
Yeah.
thought about it in terms of, hey, overall, we are trading less right now, and that's going to make things more volatile. That makes so much sense. So this is what you do, though. You are a secondary person. So explain a little bit. Maybe we should have started with this. Tell us a little bit about what you do every day.
Yeah, so while I've had a little bit of a shift over the last year in running business development, which includes a lot of other things, for the last 15 years, I've been in the capital market space. And so I started my career at a hedge advisory firm called Vice Capital Markets. Actually started as their office manager. I came from the automotive dealership world, and I was there for a few months, and I'm like, man, what are these traders doing? That looks super cool and sexy. I want to do that. And I went to my boss at the time, and I was a single mom. I had just gone through a divorce, and I had an associate's degree. And I went to him, I'm like, hey, how do I become a trader? And he's like, well, Vic, think you're awesome, but you really need a bachelor's degree to do this. And so if you want to go do that, I'd be happy to give you a shot. And as a single mom, I went back to school. I finished my last 2 years, got my bachelor's degree, went back to him and said, hey man, make me a trader. And he did. And so from there on out, like I was just in love. And while I was at Vice, I traded mandatory, traded pools, hedged for, at the time, it was about 36 clients, ran analytics, did all of that stuff. And then I went over to Quicken, which is now Rocket, and I was brought on as their Ginnie Mae trader, and then quickly became their non-agency jumbo trader. And that is a very, very different market. It functions very differently than the agency market. It's, I don't want to call it the Wild West, but there's so much opportunity there to be like, Wild West. I mean, you guys know that market better than anybody where you're at. So, but it's just, that's a place where you can really make markets. Just calling people up and being like, hey, are you interested in this? Like, I feel like this would be a really great asset for your books, blah, 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 blah. So like, I learned a ton about true capital markets in that role. And then I went to another company, and I built out their capital markets division, essentially from a glorified lock desk to a true bona fide capital markets department, where we did all of our hedging, trading, and analytics in-house. And during that time, I also started and ran a consumer direct lending division for several years, and then oversaw wholesale for another company as well. So I'm a little bit of a jack of all trades, but like at my heart of hearts, like capital markets is my passion, and it's what drives this whole business. Without the secondary market, none of us get to do what we do unless we work for a bank or savings and loans, period. Anybody that works for an IMB does not exist without the secondary market. If we're not able to sell those loans and get, and make a profit on them in order to run our company and then have cash to be able to do more loans, we don't exist.
Yep.
So, so anyways, that's my background. I'll let you guys take it from there.
Wow. So just to recap, IMB is an independent mortgage bank, and I just find it fascinating. We have a different group of the LOs who listen to this are not your average LO typically. I mean, they want to know something more than, hey, I'm just going to close a loan today. What's the rate? Sorry, that may have come across, but okay. You know what? I'm going to own it. It is what it is. There's a lot of people out there that just don't care about anything other than their paycheck. And this is not what we're dealing with our group of people typically. So with that being said, we talk about things on here that are not normally LO fare, because we believe that is super important for LOs to understand what is happening in secondary, what is happening behind the scenes, because it impacts everyone and trickles down to the consumer ultimately. So and just to make sure we're super clear, IMBs, whether you're retail or a broker, doesn't matter, because an IMB is an independent mortgage bank, and those are the wholesalers, those are the retailers, that's everybody who is not a bank, right?
That is correct. Yeah.
Okay.
And
so
it could be a correspondent too.
That's
Yep.
right. And there are a lot of brokers who swear they're brokers who have a correspondent division. So they are basically they're just a retail operation calling themselves something else. So it is what it is. In my opinion, we are so much more alike than different that the whole discussion about, oh,
I
I'm this and
agree.
I'm that. I just want to put everyone in
I
timeout.
live in
Hey, got it.
Detroit.
What?
Remember? I live in Detroit. Remember? My house is smack dab in the middle between two companies that are having that argument all the time.
Yeah.
But I agree with you. We are more similar than we are different.
Correct.
And the ultimate goal is how can we fulfill our personal goals through our professional life while giving great customer service?
Yep. Exactly.
And whatever works for you, but I like to bridge the gap, not make it wider.
Yeah, us too,
And when
100%.
speaking of customer service, when you get the phone call from your customer saying, hey, you guys sold my servicing again, and now I have to send my payments to XYZ mortgage instead of ABC mortgage. And I always explain, I go, no, we sold your loan the day we closed it. Fannie or Freddie, it goes to Fannie Freddie loan. The principal and the interest portion are sold immediately. The servicing we can hold on to, or we can sell it to somebody else. And then that person can around sell it again. So it's not the loan that's being sold, it's the servicing. You may actually own your own loan, because if you have Fannie Mae backed securities in your IRA or your investment portfolio, you actually could be making your own payments to yourself behind the scenes, and you don't even know it.
Yeah. Well,
Even-
actually, it's really funny that you bring that up. That is one of the top 2 consumer CFPB complaints. The
Servicing.
first one is escrow calculations.
Uh-huh.
The second one is servicing transfer. And this was actually just on my podcast from yesterday. Because oftentimes, and here's a great example, talking about loan officers that want to know more, and being able to help their clients with the knowledge that they have. They are truly an advisor at the end of the day, and making sure that their client understands that if I do sell your loan or sell your servicing, what that actually means. And I loved your explanation, Kevin. I think that was great, of like, hey man, they all go to Fannie and Freddie, regardless if it's through me or through somebody else that I sell it to. The only thing that really changes hands that you're going to be concerned about is that servicing portion. Who's going to handle the payment? Like, I don't work in servicing, Kevin, as the loan officer, loan originator. I wasn't going to service your loan anyways, personally. So we found somebody that we feel like does a really great job at doing that. Just in case you ever do run into any troubles.
Yep. No, that's good. And I actually, speaking of escrow, so I started in the mortgage world as a internal auditor for a savings and loan. And one of the departments that we ran into that had the biggest problems was the escrow department. We found lots of mistakes that they were making. It was a pretty high rate of mistake levels. And then the servicing department, there was another one. We actually had one time where a rep was, when the time came for her to get off from work, she would take all the payment stubs that she was supposed to process and throw them in the garbage can so she could get off at work on time.
Oh my God. Oh my
So
God.
somebody asked a question, what podcast was this on? So I actually host my own podcast on a weekly basis. My target audience really is loan officers and the broader industry as a whole. But really kind of very similar to what you guys are doing here. I bring in a lot of experts or people that I consider experts on different topics. And this podcast actually goes live on Friday. It's called Vic's Vantage. I post it on my LinkedIn, my Facebook, and you can also find it on YouTube. So different varying topics. It's not all capital markets, actually. Lots of different things, from what you can be doing on social media. Hey, I'm in the social media game just like a lot of loan officers, right? So creating brand awareness, creating value, doing all of those kind of things. Servicing is one of my favorite ones. I obviously do have a lot of other capital markets experts that I will just have some fun with on my podcast. And then other really successful loan officers that have found success doing certain things, like whether it's through coaching platforms or whatever. And I just have a myriad of people on to have really great conversations that I feel will add value for other folks.
Yeah, it's great. And I saw Vic on a podcast and I liked the energy and the information and the, it's really, it is refreshing. Okay. So let's talk about equity. CoreLogic released their Q3 report and equity increased by 6.8%. So this is a little bright, little light. It's up 1.1 trillion from a year ago. The average LTV in America. Anyone want to take a wild guess? It's shocking. I'm always shocked by this.
Under
It's
75.
either really high or really low. I don't know.
42%.
Wow.
Yeah. In
Wow.
comparison, and by the way, Dirk almost nailed it. So he guessed 40%. So 42% is our average LTV in the US. During the meltdown, guess what it was? Not
105.
What?
I said 105.
Good guess. 81%. So I thought that was really interesting for people who are expecting, the world to fall apart and it all to go to HE double toothpicks. Unlikely when our average LTV is 42%. So that is some good news. Some other good news is something we keep talking about. So in August, as oil prices were going through the roof, everyone's freaking out. And we were quick to point out that in the last 2 years, that at that point, the prices had gone up from August through the fall, and then they come back down November, December. That, my friends, has happened again. So oil is now at $68 a barrel, which is great because that will help our inflation numbers and help people, have to spend less on that. I am hearing there are parts of the country where gas is less than $3 a gallon. Mine is still over $5 a gallon. So I'm curious to know where that is. If you are in part of the country where gas is really low, let us know how that feels. I'd only
I think it
know
was like $2.95 a gallon for
How
me
much?
yesterday. $2.95.
Yeah.
Holy guacamole. Are you
We
serious?
do have really cold weather here in the Midwest, but our cost of living is definitely a little bit lower.
Wow.
Yeah, but see, you also have that 85 octane in Michigan that we don't have out in California. We have to have the better premium stuff, And
I
then
see.
Audrey buys the extra premium stuff because she believes that her BMW will only run if she gets the highest octane stuff in her tank. Even though one day we were driving someone, I flipped in the 87 stuff and she never noticed the difference.
Okay, tricky. I know. That's rude.
Audrey,
Yes.
I wanted to take it back to you. You brought up that stat about equity in homes and the average LTV being 42%. Now, I feel that this is one area that all originators can step up in because by most measures, and we're going to talk about this too, Audrey, you actually tuned in and read quite a bit of stuff on the conversation that Jamie Dimon recently had with a group of mortgage bankers. And he believes it's going to be a real rough go next year. I would have to agree with him. I know everybody's been calling for a recession for the last 2 years. I think us as mortgage bankers have been calling for it more because we know that that means good stuff for us. So I think for us, it was more wishful thinking over the last year. But a lot of things are indicating that we are going to, we already had the soft landing. Now it's going to be bumpier from here for the broader economy, not necessarily for the mortgage industry. But this is a really great opportunity for mortgage originators to truly be advisors and call your past clients and say, hey, look, I get it. If you don't want to move, if you don't want to refinance, whatever, but make sure that you're aware of what's going on in the economy and what's coming down the pike. Because if things do get rough and you do want to do that cash out refi, this is what your financial situation is going to have to look like for you to be able to do that. So gives you a good opportunity to chat with your borrowers right now and not even ask for anything. If you got some time, like, again, like a show like this is super great to be able to create value for your clients. So, anyways, I'll get off my soapbox.
You're 100% right. And I was talking about this last week to a group of people. I was giving them ideas for, because a lot of times you hear people go, oh, well, I don't have anything to talk about if I call my client because they have 3%, 2%, whatever. What the heck would I say to them? Okay. So these were a couple of things that I had brought up that I thought were interesting. So I had a conversation with a client who bought their house and they're young and they're in their 30s. They have 2 young kids. And so they were able to get into a house, buy it, and get a really low rate. So apparently the only thing that they talk about with their friends ever are kids and houses. And so their friends are all lamenting the fact that they don't have a house, they haven't bought a house. And the headlines, if you read and just see what the media is telling you, you can't buy one. It's unaffordable. Prices are going to crash. You should wait till the rates come down. You should wait till everyone's in foreclosure. You can pick up one of those at rock bottom prices. It's all a bunch of hooey. And we are the ones who have to tell them that. So
Yep.
in my conversation with her, I explained what was going on, that we are probably at the lowest point as far as where prices are going to be, at least in the foreseeable future, that now is the best time to buy because there's not enough inventory. And with the rates as high as they have been, people don't think they can buy. So there are actually less people, even though there's still a ton of competition. So please. And so she promised me, she goes, okay, next time I'm going to tell them to call you, because again, the media is telling everyone you can't buy a house now. It's the same thing with, the black home ownership rate in America being the lowest it's ever been, lower than when it was legal to discriminate against black people. That is unacceptable, but it's because people have been told, oh, you can't buy a house. Oh, this is not going to be something that you can do. So all these people out there need to hear a different message, and we're the ones to do it. So I also said, oh, go ahead, Victoria. Because
I was just going to say, you said something that I absolutely love. And that was, I will call them next time. You will call them. You're not going to create a little meme that you're going to put on social media that has a cute little saying and thinking that, your borrower's miraculously going to call you because you did that. No, that's great for brand awareness, but actually getting on the phone and discussing somebody's personal financial situation and how you can help them and how your knowledge of the industry and what's going on in the market can help them. I love that.
Yeah, it's a big deal. It's something we talk about a lot, and we have a myriad of different people on here. And one of the things that LOs have always cringed, we've always been sort of free thinkers, and they always joke around that, getting LOs to do anything is like herding cats. Well, it's because we're also independent. We've always been entrepreneurs. So even if you're on a W-2 at this point, you're still an entrepreneur at heart, right?
100%.
So with that being said, a lot of us missed how important being systematized is and having routines and habits. And actually I have my eye on a really amazing speaker that I'm hoping to get on here shortly, that is all about this. But it is so important that we shift gears and not try and do what we've been doing for the last, 40 years that we've been doing this, in 2024. And if you didn't like your 2023 and you think you can do the same thing or not do the same thing, that, you know what I mean, in 2024,
say that exact same thing. If you want
not going to happen. Okay, I'm just
do the same thing you did in 2023. If you don't want it to be the same, you got to do something different in 2024.
Totally. So here are some other ideas for when you call your clients. I just want to throw this out there. Maybe they want to buy an investment property. So I had a client call me this weekend, and I've known him since he was a kid, like literally like in his 20s, when he had his first real job in his profession, and he was putting together like pennies to like be able to get himself into his first place. I know him before his kids were born. So now his kids are one's almost done with high school, one's in college. So it's really interesting. He bought his dream home, he and his wife, a couple of years ago. They got a great rate. He has no reason to refinance that thing. He's probably got, I don't know, we estimate $400,000 to $500,000 more in equity today than he did when he bought it 2 or 3 years ago, because of what the owning a house does for you, right? But in the course of my conversation with him, which was actually him saying, hey, I need a good financial advisor, he mentioned that his daughter is going to need housing where she is going to school next year. And so now what we're looking at is him buying a condo or a house for her and maybe some roommates to live in while she finishes out the next 3 years of college. Okay, he's got a 3% rate on his, or whatever it is, on his dream home. What would you talk to him about? Well, gosh, look what happens. So now maybe he's going to do that. And then eventually he'd like to buy an investment property, but doesn't feel like he can do that yet because of where he is. So there's an idea. Buy a house for your kid in college, buy an investment property.
And with FHA, it's owner occupied. It's not an investment loan. You buy it for your kids in college. It's a pretty sweet deal.
That's also a great recommendation, Dirk. I see in the comments.
I can't see the comment. What did Dirk say?
It says, buy a 4-unit property with 5% down and have the daughter occupy one of the units.
Yep.
Fanny also.
Exactly. Help your kids or grandkids buy a house. Consolidate debt. We keep talking about how we have topped out over $1 trillion in debt in the US. Average credit card interest rate is 25 to 30, sometimes 32.99%. Student loans off the charts. So make sure you're doing those blended rate calculations to see, does that 3% still serve you? And then also, there's a huge disparity on HELOCs these days. They were 3% lower in 2022 than they are now. So they've gone through the roof. And so don't just take someone at face value and go, okay, you want a HELOC? I'll give you a HELOC. No, do some math, people. Do some
I don't
math.
even want to talk to you about my own personal HELOC. It like it makes my stomach turn.
Oh my gosh. Well, we can help you with that. So, okay. So let me ask you why you haven't done something about that. What is keeping you a little insight into a consumer in their mindset?
Oh no, I just mean like the overall interest rate. I mean, I don't have anything on it or anything.
Oh,
but
there you go.
yeah,
Good. I'm like,
Oh, yeah.
okay, so why are you sitting on that? Is there a reason? Okay, good. Yeah, exactly. Well, and you ask someone what their first mortgage is, they know exactly what their rate is. You ask them what the rate is on their HELOC, no clue.
Yeah.
Most of the time, they have no idea. So again, people have to ask good questions, but that's what will differentiate us from a computer.
And a lot of people, when they're shopping for a HELOC, they'll go for the teaser rate. And they're like, it lasts for 6 months or it lasts for a year, and then they're stuck with it. The margin. The margin is ultimately the most important thing on a HELOC because they're all tied to prime. So that doesn't.
Yep.
So I have actually seen lenders in the last few months that had negative margins. If you could ever find one of those, just grab it and run. Just the only trick with it is make sure there isn't a floor on it that's at current rates.
But I think to your point, like that's exactly what people should be doing, calling their borrowers. You know how many of their borrowers probably do have a HELOC right now?
Yeah.
Yeah.
I mean, with all of this equity in their home,
Yeah.
most financially savvy people do.
Yeah.
But then also remember, so there was a major bank that stopped doing HELOCs like 2 or 3 weeks ago. Just remember this during the meltdown where, I mean, someone had a
Yeah.
HELOC, they're in the middle of a construction project, their kids in the middle of college, and boom, out of nowhere, it's closed for whatever reason. So just, it's not the most successful way to manage things just in general, but talk to your borrowers is the point. So, okay, so we have a few things I want to go back to. So one of them is, we had started to talk a little bit about retail sales, which in the last few months have really shown that consumers have tightened their belts and are really focused more on necessity items, not, extravagant luxury items. And I was talking to somebody today who is part of a local association of retail, little small businesses. And he was saying that they're freaking out from the ground level. They're off as much as 30% a year, and they count on the holiday season being where they make it all up, and it's not happening this year at all. And they don't think it's just, I mean, they think it is that the retail sales, like Black Friday numbers, et cetera, were maybe not as great as they appeared to be at face value. So you had some interesting insight into this. And also, I want you to talk to us about the Yolo cohort. I think that is fascinating.
So a couple of things, actually, Bank of America puts out monthly consumer trends. And one of the latest monthly consumer trends that they put out was actually that higher earning income households actually had less disposable income, and it primarily due to their mortgage payment and interest rate. So you have that factoring in, because like when you look at over the last year, the average income of a home buyer was crazy high compared to years past. And that's because the only people that can afford homes right now are high earners. Like they're not your low to moderate income people. And
Right.
Fannie and Freddie are pushing really hard to get more low to moderate income people into homes. But unfortunately, knocking off a few points in LLPAs is not going to do it.
No.
It's a much broader topic that needs to be tackled and handled. But anyways, what they were saying was that all of those staple items where most of your lower to moderate income people were renting, and in most areas it's cheaper to rent than to, I shouldn't say that. That's not true. But for those lower to moderate income people, for those higher earners, they have less money to spend on the luxury items and those kind of things. But then you have this whole YOLO cohort of people. And what this is you only live once. So this really came out of the pandemic, and I've been on a number of different podcasts or webinars or whatever since the beginning of the pandemic. And I'm a little bit of like a side psychology buff, and kind of like what this did to all of us as humans, like locking us up for a year, 2 years, depending on what state you lived in. Once you're let out, people want to live, right? Yep. And cost be damned. Like, they're going to go out, they're going to spend the money. And this is actually a cohort that people like on Bloomberg are following to see where's the breaking point for these people. Right. Like, you still see people all over Instagram posting their pictures of their vacations, all of this stuff, while also complaining about the cost of groceries. Yeah. Now, conventional knowledge would tell us like, oh, just buck up, make the right financial decisions. They don't want to. They want to go out and they want to live. Right. Even more reason for you guys to call those borrowers, especially the ones that were on the margins, your first-time home buyers, that I'm sure a lot of you guys worked with over the last year or so, because that's a lot of who was buying homes, at least in the Midwest and the Southeast. And I know you guys are West Coast, but even more reason to have conversations with those folks. So yeah,
I just went on a flight up to Portland, Oregon to visit my cousin. And on the flight back, there was a bunch of millennials coming on, and they all had boxes of donuts with them. They had literally, as a group, gone to this donut shop in Portland.
Voodoo Donuts. Voodoo.
No, it was not Voodoo Donuts. It was another brand new upstart. And the thing was that people were like, "What the heck is all these people have donuts in the waiting area?" And they're like, they weren't even special donuts. There was nothing particular like Voodoo Donuts. Definitely worth going to Portland for Voodoo Donuts if you like donuts, but they're not special donuts. They don't taste any different. They're still just donuts. But Voodoo Donuts, if anyone hasn't been there, they have like themes to the donuts, and like a lot of Halloween themes and kind of stuff like that.
They don't even look like, it's not just Halloween. They don't even look like donuts. They look like they're piled high with all sorts of sugar, magical things.
Lots of sugar. But anyhow, yeah. So it was like, wow, my God, these people just went to Portland just to have donuts. That was it.
So here's another fun stat. On November 26th, it was the highest air traffic day in history.
Wow. Yeah.
Ever. And with everything that we're facing, that we're thinking about what might be coming down the pike for the economy in 2024. And that was the highest air traffic day. That tells you that there is a fundamental disconnect between people's, what they want to do and what they're going to do, and what's traditionally made sense. And honestly, I feel like that is probably the biggest thing that the Fed has to fight, because they're basing all of their, metrics and tools and everything that they can do based on past consumer behavior.
Yeah.
And that was the scariest part of the pandemic as a whole.
There's no logic involved here. It's all about how they feel.
Yeah. And what they want.
Well, it's true, but I mean,
and what they deserve. That's the thing.
Yeah.
I deserve. You have it. I want it. I should have it too. It doesn't matter whether I don't want to work as hard as you ever worked or whatever. There's a restaurant downstairs from my office, and it was really interesting. So during the pandemic, I came in lockdown. I came to this office. I literally have pictures of my street, which is a very well-trafficked street with a lot of businesses, et cetera, on it, with not one person and not one car, right? So it went from that to, then it opened up. And then the makeup of the people in the restaurant was really interesting. Like, people from all over the place were down there and just in droves. And then as the rent, the moratorium on paying rent, all that came to pass or passed, then it started to change again. It's gotten to be less, and you can see it, but it's really interesting to see what I could see from upstairs looking down over a restaurant, because there's still a lot of people down there and that weren't there before. It's fascinating. And Kevin, his favorite measure of what's going on anywhere is the number of tower cranes in a city And, and then we both look at the Bay Bridge when you're crossing the Bay Bridge and you look over to the Oakland side and you can see how many container ships are out there waiting to be offloaded, right? And
Yep.
so all these little,
not as many. Lowest number of tower cranes in years now in San Francisco. So it's a big sign.
well, and it was also interesting. So Kevin was in Dublin and Ireland, and he told me that there were 80 tower cranes when he was in Dublin. When was that, Kevin? A year and a half ago?
It was a year and a half ago. Yeah.
Okay, so I was there 3 weeks ago, and I couldn't understand how he knew how many tower cranes were in Dublin because I'd see them, but I didn't know. Then I went up into the top of the Guinness brewery, and it's this panoramic view, and I'm like, oh, this is it. This is where he counted it. Like you could go like segments by segment, and there were less than 2 dozen. So definitely things have shifted and are shifting by our little anecdotal, observances, right?
I love this. And Audrey, you and I discussed this briefly. One of my favorite people at the Mortgage Bankers Association is a guy named Joel Kahn. And Joel is the #2 to Mike Fratantoni, who's their chief economist. And Joel has this chart or slide that he refers to as the Instagram economy. And basically what it does is it kind of takes a measure in an anecdotal feel of what's going on in the economy based on what people are posting. Are people going out and buying the luxury handbags and getting their nails done and their hair done and all of that kind of stuff? Or are people posting more about how much groceries cost and the fact that they can't afford to get their hair and their nails done anymore? And that's actually something that I love following. I have a lot of, folks on my Facebook and Instagram, and just like going through and like seeing what other people are doing. And then I'll compare notes because, all those platforms have an algorithm and they're going to send you what you want to see. But
Right.
like also comparing notes with my friends, I'm like, hey, are you seeing the same stuff? And I mean, that I feel like it's a pretty good indication of where the economy is going, believe it or not.
Yeah. Well, Disneyland's another place where you just watch and you go, holy moly. Okay, a season ticket's $1,800. They literally ran out, like cut it off. But you go there and you see people like decked out in all of this stuff. And all I've got the whole time is a cash register in my head going, I know you can't afford it. I can't afford this. I don't want to be here. I'm not buying all that crap. And you are. How are you doing this? Are you paying your rent? Are you paying your PG&E bill?
YOLO girl.
Oh my gosh, crazy, right? Okay, so back to jobs for a minute, just because all the unemployment or most of the employment growth that we've seen recently is in the service sector, right? So white collar jobs are harder to get these days, right?
Yep.
So you don't want to let go of your white collar job. So I was just thinking about that when you were talking about how higher income households are spending more, et cetera, for their mortgages, and they have less discretionary income than they used to. So that it just ties together, but there is slowness happening in that employment sector for sure.
Yeah.
So
you see articles of like Bloomberg, or not Bloomberg, but Amazon and Google. They're not cutting the blue collar jobs. They're cutting the white collar jobs.
Yep. Yeah. And for all those people who are objecting to the requirements to have some of those jobs, it's going to get harder and harder for them to say, I want to work from home when they're being asked to come back into the office. So it's going to be fascinating to watch how that all moves together as we watch office space and what happens with that going into 2024, what happens with, I mean, the whole thing, I'm just fascinated by it. So let's talk about 2024, shall we? So it is upon us. So from what I'm seeing, I'm thinking it's just going to keep getting better, right? Our rates have come down some. Our values are solid. People are still very employed. The forecast that I'm seeing for rates, it varies. And I always remind people, I'm like, okay, if you look at FHFA and Fannie and MBA's projections for 2023 for almost everything, they kept revising them either down if you're talking about origination volume, or up when it came to rate. I mean, nobody was saying, oh, by the end of, by the middle of 2023, we'll have 8% rates or third quarter. Nobody said that, right? So I kind of take it with a grain of salt, sort of, but it's something to be thinking about. So I'm seeing projections for 2024 of around 4.4 million units sold, properties changing hands, and rates probably hovering 6.1%, and then edging down ever so slightly into the fives through 2025, 26. Dave Stevens is a little bit of an outlier. He thinks we'll see the fours. I haven't grilled him on exactly when he thinks that will be, but he's a pretty credible witness to all this. So anyway, going into
I love your Audrey did a little presentation down at Silicon Valley last week, and she called everyone out who does projection. She goes, I don't know one person who predicted 8% mortgage rates, and yet here we are.
So Audrey and I had a little conversation about this, about when everybody's going one way and you have one outlier, listen to that outlier.
Yeah.
Now, I don't know if I agree to 4%. This is what I will say on any kind
fours.
of projections.
That could be 4 and 7/8, right?
That's true. That's true.
And he was talking through 2025, 26. So it's not necessarily 2024. So just be clear.
Oh, I just lost my train of thought. This happens to me sometimes.
Outliers. What's happening in 2024?
Yeah, I mean, I could pontificate on all of. Oh, there it is. Now I got it back. So we're thinking of things in terms of what we know today, right? Like if everything stays the same based on all of the economic indicators that are coming out and all of the things that we can measure, but then sometimes we get thrown a curveball like a war. And those are things that we can't plan for. And we still have a lot of angst going around in different parts of the world. And, we don't know how that's going to play out. Now, let's say, barring anything like that, I would say that I'm in agree. And here's another thing. I typically listen to the market before I listen to economists. And what I mean by that is that the market actually has money in the game. Yes. Like these are investors that are betting on things happening one way or another versus an economist that is paid for their opinion. Those are two very different things. Yes. Now, that doesn't mean that we don't need economists and we shouldn't listen to them and, that they're not digging into a bunch of things that we're not. But I'd rather go and listen to the people who actually have the skin in the game and what they think is going to happen. And what they think is going to happen is that we are going to see some rate cuts come March, April, potentially. Actually, I looked at it today, and the market right now is predicting, and this changes all the time, right? Yeah. But in general, the market is predicting that the Fed funds rate is going to be a point lower by the end of next year.
Yeah. They're saying 5 rate cuts next year, which is hard to imagine, but
I can't even see it.
I can't either.
Although it could be 2 halves.
Exactly. It doesn't have to be 25 basis point increment moves.
Yeah, you're right.
But like that's what's being projected right now. And I could see something like that happening, which obviously would lend to lower rates.
Right.
One other thing that I do want to just mention real quick, just like we saw on the upside of it, meaning like the bond market preemptively prices this stuff in. They preemptively priced it in on the way up, and they're going to preemptively price it in on the way down. One caveat that I want to call out though, that does not mean that the investors that are purchasing these loans or the investors purchasing the mortgage-backed securities, yes, they're going to follow what's going on in the bond market. But if you're a company that sells to aggregators, this does not mean that the aggregator is going to give it all back immediately, just due to like the volatility in the market. But we will see some reprieve, and we will see it before it actually happens or is announced by the Fed.
Well, just to spell that out a little bit, again, the servicers are worried about prepays. So they're worried about, okay, we fund a loan today. It's at, okay, let's go back to, it was at 8%. I mean, the second someone can do even 6 7/8 or, whatever, they're going to be jumping all over that. Well, if that happened 2 months ago, you've just lost your skin, right? So it is a really tough market for servicers. And so it's something that I was interested in just picking your brain a little bit about as far as how you price on the secondary market, because we'll watch, huge swings in treasuries or bond market. And then we're not seeing such big differences in the rates. And that has something to do with it, right?
It absolutely does.
Careful.
Yep.
Yeah.
So I just did this podcast yesterday with Seth Sprague, and he was talking a lot about how the first 3 quarters of 2023, if you were an owner of servicing, meaning you were a company that retained servicing, that was a write-up on your books. Like, you actually got to show more profit because of that servicing. Interest rates have gone down, tremendously over the last 30, 60 days.
Right.
The 4th quarter, it's a write down for a lot of those companies.
Yeah.
And so they have to figure out how they're going to make that up. And when you're a mortgage-backed security investor, like, it's the same deal with mortgage-backed securities as it is servicing. You want those things to stick around for as long as possible, unless for the servicer, let's say that you're selling your servicing to a company that actually has a really good way to recapture that loan. That's another thing to think about when you're a loan officer. If loans are being sold, that the company that you're selling it to is going after that client just as hard as you are. So luckily, you'll probably win because you have the relationship, but keep that in mind. Like, don't sleep on those notifications that are being sent to you for refinance opportunities when they come about.
It's that, like, oh, it was real simple. They said they had everything and they just needed to, drop the rate. And then it turns out they don't have everything, but they lie to them, get them in the door. And then the process started. Well, I'm committed. I'm going to go.
Yeah, even more important to stay in front of your clients, because it's not just the market as a whole. It's going to be those companies that you sold the servicing to that's going to be going after those clients as well.
Yeah.
But with all of that being said, yes, that's why rather it's your own secondary marketing department or the aggregators that you're selling to, they don't give it all back when the market gets better, because number one, there's a chance that it's going to rebound super fast. And number two, there is that loss of servicing, that prepayment risk that has to be accounted for.
Well, have you seen those numbers, those retention numbers from the servicers though? I've seen like 17% of loans are retained by the servicers because they aren't doing a great job of keeping in touch with the borrowers, and there are some exceptions, and one of them is one of your previous employers who I refuse to send a loan to ever, because they're all over that and then some. And then
let me give you some inside baseball on that one.
What?
So I said, let me give you some inside baseball on that one. So one of my previous employers that shall not be named, but maybe one of the largest mortgage companies in the entire country, because they are so good at that, and they are, make no mistake, they are phenomenal. They freaking wrote the book on recapture.
Yep.
But because of that, their bonds don't trade as well in the secondary market.
Interesting.
Because anybody who is purchasing their bonds know how good they are. And so they actually have to put parameters in place that say, we promise we're not going to do this to you. Will you please give me that price?
Interesting. Well, and funny, I heard one of, it was the CEO, I don't know, a number of years, like probably 6 or 7 years ago, speak, and their philosophy was really, let me boil it down very simply. My favorite thing, they would just throw a tremendous volume of loans against the wall, and they were happy if 30 to 40% of them stuck. So they wanted the cream of the crop, and they didn't really care about the rest. And, from there, you just were on your own. Which explained why I would get fallout. I was doing 3 or 4 loans a year that were perfect from my perspective, that they didn't want to do, or they didn't follow up, or whatever. They have some ding dong in a call center. It can't, figure out which end is up. So
they're order takers.
Yeah, exactly. Which we're not in an order taker
environment
economy right now. The loans right now are not simple.
Believe me, as somebody who ran consumer direct lending before, this is not the market for it.
Not at all. It is crazy. You got to work for it. So to recap, you have to hustle, work hard, and figure out what your plan is, and then execute. So with that, holy moly, thank you so much, Victoria. This was great. We appreciate you very, very much. And next week, kids, for real, we have Dan Habib with MBS Highway joining us. He was sick a couple of weeks ago and wasn't able to join us, but he'll be joining us next week. So
Victoria, what's your website again, or your videos?
Oh, so the name of the show is called Vic's Vantage. It comes out once a week, and it is hosted on YouTube right now.
Beautiful.
Great. Thank you so much, Victoria. Thank you, Kevin. Have a great
Thanks,
week,
guys.
everyone.
All right.